Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's February the 15th and we have our guest today, Jeffrey Halley, independent market analyst. Jeff, great for coming and thanks for coming on the show today.
Always a pleasure, Brian.
Now, Jeff, before we get your insights, let's take a look and see how markets across the region have been performing in the first half of the day. We start with Singapore. The Straits Times Index is up 0.9%. And looking across the rest of the region, we've got the KLCI out of Malaysia. That is down 0.08%. Shanghai is up 1.28%. The ASX All Ordinaries is up 0.73%. The Nikkei is up 0.87%. The Hang Seng is up 0.22%. Rounding up the numbers, we've got the Kospi, which is down 0.21%. Jeff, your view on market performance in the first half of the day?
Okay, just to emphasise, Shanghai's actually closed all week, so I think it's just a little bit there. That's okay though. No problem. Looking around the rest of Asia, I think we're seeing a reflection of this Federal Reserve. Will they cut? When will they cut? Ping pong back and forth in markets. That's been going on for the last few weeks. So overnight, after that data that came out earlier this week in the US, where everybody went risk off, Janet Yellen, the Secretary of the Treasury, came out last night and said 1 month's data points doesn't matter. That was all the green light that Wall Street needed to start bottom fishing equities, bonds, and sending the dollar a little bit lower. So that rally we saw overnight, I think what we're seeing in Asia today is a continuation of that sentiment, and that inflation data is fading very quickly from the market's minds.
Now, Jeff, we had less than stellar some data in Asia this morning. We have Singapore, which missed GDP expectations. Mm-hmm. Japan also entered technical recession territory. What are you seeing, and how is this going to complicate the BOJ's plan for Japan?
Well, taking a look at some of the other data points first, I definitely feel that this rate cutting momentum is going to grow from here. Ex the USA, the rest of the world isn't doing quite as well. Softer UK inflation yesterday, flat Euro GDPs yesterday. As you said, very weak employment data from Australia today. And of course, Japan has entered a technical recession by having 2 consecutive quarters of negative growth. That is going to complicate the Bank of Japan's plans for starting to move itself out of this multi-decade quantitative easing negative interest rate policy. So I think that's a bit of a spanner in the work, and it may put upward pressure on the dollar-yen cross, which is above 150. That may give it some momentum, despite the fact that markets get nervous about BOJ or Ministry of Finance intervention when that dollar-yen moves above 150. But I do feel that these rate-cutting calls are going to get louder and louder now around the rest of the world.
Okay, there's a lot of moving parts now, besides the geopolitical risk around the region, and then you have this around the world. And also then you have this dichotomy around the US doing really, really well, chugging along very nicely, but then other economies, China being the extreme case, not doing so well. Now, this has also then impacted commodities, and one of which, of course, which should traditionally be the case, is oil. But then we've just got some interesting US crude inventory numbers that showed a gain of 12 million barrels overnight. Walk us through your expectation on oil prices moving forward.
Well, part of the reason the United States, and you could perhaps lump in Canada and Mexico into that equation as well, aren't suffering to perhaps the same extent as other parts of the world, is that the United States is energy independent. It produces more oil and gas than it needs. It's a net exporter. And given that its economy is, I think, 80% of its GDP is internal consumption. It's not manufacturing or exports. That was a galactic number overnight, that 12 million inventory increase in the United States, which shows you just how strong oil production is. And I'm beginning to think that Brent crude in particular may have trouble holding above $80 a barrel now, and that the US production numbers may start outweighing the geopolitical risks that are built into oil prices at the moment. And into that, we can also add what appears to be sideways to slowing economies in many other parts of the world.
Now, then, how about two other commodities, perhaps not quite correlated, but definitely, gives us a different barometer. One is, of course, the traditional gold, and gold has breached the 2000 mark. And then the other one being, of course, the Johnny-come-lately Bitcoin, which obviously now is increasingly seen as, in some circles, interchangeable with gold in terms of a hedge against inflation or a store of value, whichever person you talk to. Walk us through your thoughts on those two asset classes.
Well, as far as gold goes, if inflation is actually moving lower across the world and geopolitical risks are being priced in everywhere, two of its underlying raison d'etres are being slowly eroded. And I always get nervous when gold goes above $2,000 an ounce, because it often turns out to be a bull trap. And looking at the technical picture, it's fallen below 2,000 now, about 1,990, I believe it at the moment. I think the key level for gold, though, is the 200-day moving average at 1,965. And we could see a much deeper technical correction if my interpretations of the charts are correct, if that level breaks. Bitcoin, I don't think it's ever been an inflation hedge. I think it's been a bull market asset class, and that's what we're seeing in equities. And as the dollar falls, as interest rates, as inflation falls, then that is giving Bitcoin more momentum, apart from the speculative momentum that it's had. So it's definitely being a winner, I think, at gold's expense at the moment.
Now, finally, Jeff, we're in the middle of the week. It's in many parts of the region, it's still Chinese New Year holidays. Not everyone is back at work. What should we be looking out for the rest of the week from a data points or events that could move markets globally?
Yeah, it's pretty quiet, to be honest, as far as tier one data goes, but we do have US retail sales tonight. Now, markets are pricing in basically a 0% growth for that number for last month. If that number comes out higher, say, 1 or 2% growth, we could see some more of this Federal Reserve ping pong going on again, where the short-term money will then move to the Fed's not going to cut anytime soon, and they may buy dollars and sell stocks and sell bonds. So I think that's our big risk tonight, that we see more of this sharp two-way price action due to markets trying to price in the Fed easing trade, but then changing their mind and then changing back again. And I think we're going to have to put up with this sort of market for a while now.
Now, on that note, Jeff, thanks for your insights. Thanks for coming on the show.
A pleasure.
Now, we've been speaking to Jeffrey Halley, independent market analyst, and this has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.